So let's talk about decoding the market's whispers. Now, to be honest with you, in order to become a successful, I'm not going to use the word profitable, but successful trades aren't always about making profit. Successful trades are also about exiting the market with a small loss or the contract, the asset following the rules you set up for your trade. Now, there are probably as many trading strategies as there are traders, but all trading strategies and trading plans are created equal. I suggest that you find some strategy and then build a trading plan around them. Now, there's a plethora of trading strategies available to you, but I also encourage you to create your own trading strategy. By doing this, you are understanding and hearing what the market is saying to you. And remember, we talk about dog whispers, we talk about horse whispers. If you really get a fine handle on what you're doing, you'll understand what price is trying to tell you on a chart. But one of the biggest disadvantages and one of the worst things that I see for novice traders and nouveau traders is that when you trade CFDs and you trade today with our online brokers like Alvexo, there's hundreds and hundreds of assets available to you. In many classes, you can trade stocks, indices, currencies, commodities. And what happens is too many traders jump all over the place. And 1 minute they're trading Meta, the next minute they're trading Alphabet, and the next minute they're trading Bitcoin, the next minute they're trading the euro. What happens is you can't get to the point where you're hearing the whispers of the market. So when you build and test your own strategy, you're the master. You understand all the ins and outs, and you are not just trying to duplicate someone else's thoughts. Now, I always encourage traders to develop their own trading strategies. That's time permitting. Now, I'm not talking about reinventing the wheel. There are many tried and true trading strategies out there, but you have to make them your own because you couldn't read the novel that somebody would have to write about all the ins and outs of a particular strategy. Or again, the whispers of what the market's saying. I couldn't impart to you, no matter how much I tried, all the information and the experience I have in my head. So I can give you, or another teacher, another guru, can all give you a set of rules. We can give you a set of guidelines. We can give you some knowledge. We can give you some things to think about. But I couldn't tell you how to use my support and resistance trading strategy. I can give you the steps, I can give you the rules, but I can't give you that intuitive feeling, that whisper from the market that lets you know, uh-oh, don't do that, or let's jump in now. So first, when creating strategies, it requires the traders or yourself to develop a greater knowledge of the market and its overall price movements. Secondly, when one develops their own trading strategy, they are tuned into that strategy works and what will cause it not to work, and they will be in a much better place to adjust when needed. Even if you trade someone else's trading strategy, test it thoroughly, and in the process, make it your own as you learn the ins and outs of it and possibly adding your own twists. Now, this is a time-consuming part of it, but you see, a lot of newer traders want instant gratification. And they want to learn something now, go trade it and be online trading, in an hour. They want to say, I read everything about it. I watched 2 YouTube videos. I watched this video and I got it down pat and I'm going to start trading. Okay. The fact is the markets aren't instant gratification. If you find a way to enjoy the overall process of trading, not just the initiation of the trade. Like, let's talk about a professional basketball. Let's talk about a professional football player. A professional football player starts trading or training in high school. They play high school ball. They learn a little, they get a little bit better. Then they go off and play college ball and they get a little bit better and they learn a little bit more. It's not till they reach the professional stages that they really start to become defined players. And these players get up early in the morning and work out. Then they go to scrimmages. They watch videos of all the plays. They read playbooks. They memorize plays. Then they practice some more. All of this goes in to making them a real trader. It's not an instant gratification. When you see that game start on Sunday and you see that new quarterback throw the touchdown pass and you say, wow, he's amazing. He just started out and look what he's doing. You don't realize he spent years of training, hours and hours every day getting that. And this is what trading should be about. It's not just that snap and that receiver down the line and that score at the end of the game. That's your final gratification. And you're getting gratified by all the work and the time you put into it getting there. And the more time and effort and the more enjoyable that you make it. And you can make it very enjoyable. I've been trading for a long time, play little games with myself. I'll look at a chart and I'll say to myself, I'm not looking at a trade. I'm going to look at, let's see if it's going to jump 10 points in the next 5 minutes. Not that I'm not making a trade. I'm just playing a game with myself. Imagine like playing video games, trying to figure out what the characters do. No money on it, just making it enjoyable. Now, in short, you want to start by analyzing your charts. So whether you're a video game player, whether you're a sports player, whatever you are, the charts are your playbook, are your information source. Because price is the most important thing. Because price never lies to you. And price is also where, or on your charts, is where you'll start to develop your plays and your trading strategies. Now, again, you don't need to start from scratch. But the easiest way is if you play a game with your charts and look at your charts and see opportunities that happened that are over. Look at that. The euro fell 22 points today, and I could have made, okay, well, how would I have seen that? And go back and look at your charts. And what would I have been able to do ahead of time so I could see that and start building your strategy? What am I going to look for next time? And what am I going to look for in all the assets that I'm trading? So remember, test and modify. So when you develop your trading strategy, you'll start out with a set of recommendations from analysts, other traders, teachers, whatever. But try these out on your demo account and modify them as you see things happen. It's important to create your own formula for success, and this will improve your trading. But again, don't reinvent the wheel. And remember, not every strategy is for everything. Decide what you want to accomplish. Okay. Is this a play that you're going to use when it's 4th down and short yards? Is this a play you're going to use when you're 2 points behind, the whistle's about to blow? Okay. Do you want entry points? Do you want exit points? Do you just want to hold on the ball and run out the clock? Okay. So when you decide what you want to do, then you have to know which part of your strategy or what strategy you're going to use or what pointers you're going to use. Now, one of the most important things on your charts that you can start to learn about that will help define all of your plays is what we call support and resistance. And imagine, again, on a football field, these are your 5-yard lines, your 10-yard lines, your price movement as the ball's being moved up and down, back and forth. These support and resistance lines will help you understand whether the bulls are coming in, the bears are going out. And it's what makes you a better trader than the guy around the corner. Now, your support and resistance lines are levels above and below price. Okay. So see all these dashed and dotted lines? Now, this is the Euro US dollar chart. It's my standard teaching chart. All these dashed and dotted lines are actually my own private code. You can have your own private code. It's got nothing to do with the value of the line. It tells me how long ago that level was developed or how strong that level is been in the past. Okay. Now, if you think of support and resistance as, you can do it 2 ways. They're either floors on an elevator or they're steps on a ladder. So let me tell you a story. Okay. You go into an office building. Every day you take the train to work. You get out on the corner, you go in this office building. The first floor of the building is, coffee shops and little cafes and donut shops and little odd and end stuff. And you go in there in the morning, every morning, grab your coffee and go across the street to your office and go to work. Well, today, for some reason, the train got you in 15 minutes early. You don't have anything really on your schedule this morning. And you say, you know what? I've never looked around this little office, this little first floor, except when I grab my coffee. So today you decide you're gonna take your coffee in your hand and you're just gonna mull around this little, it's nice. And it's outside, it's kind of icky and raining. So you want to be inside anyway. And so you look in the store windows, you look in the dress shop, you look in the men's shoe shop. And then you see a set of elevators. So you walk down to the end to the corridor and you see these elevators. And while you're standing there, the door opens. Okay, you're on an adventure today. You step in the elevator, and the elevator goes up a floor or two, and the door opens again, and you see these big, beautiful corridors with wood panels and beautiful carpet and a reception desk, and you can see the signs hanging inside, and you can see it's all lawyers' offices. The elevator door closes and goes up a little bit farther. It's not a big office building. It's not a high, a huge. It's a low-rise building. Goes up another floor or two and opens up, and now you see it's conference rooms. Door closes again, goes up a little farther, and it says roof lounge on the button, and opens up, and you can see this smoking lounge out, outside of people going outside and smoke. You see a little vending machine area. You see a place where people can sit down and eat their lunch. Door closes again. It goes down, stops on different floors, goes back down. Now, what was this? You were observing. You never got off the elevator. You never touched anything. You were observing. And this is how price moves. And you're observing your charts. Now, you notice each one of those levels or each one of those floors, the elevator moved up. When the elevator came down, those floors still stayed the same. Now, I bet you, with a little bit of thought, you can start telling a story about that elevator. So you get off the elevator and you see, 4 or 5 people jump in the elevator. They're all some men dressed in suits, some women dressed in nice dresses, and the door closes. Now you say to yourself, you know what? I know that elevator is going to stop on the next floor because they all look like lawyers or people who worked in lawyers' offices. And it's the early morning time, so it's time for people to start coming to work. And it does. The elevator goes up. You're not on the elevator. You don't see what's happening. But the elevator goes up and then comes right back down and it's empty. Now the elevator door shuts and it goes back up. It goes back up to the 1. And guess what? You're venturing that either some of those people are going to come down because they just want their morning coffee. They put their briefcases in their office, or they're going to go up to the roof deck because they're either going to smoke or they want to sit up there and have their morning coffee. And what you've done is you've now analyzed the markets. You've analyzed them, and you also know the levels that are important in that journey of the price. And if you can look at this journey of price and tell a story, you can start making smart trading decisions. Now, if you imagine all of these lines on my chart, as different levels of floors in that elevator's journey, but say, for instance, now you journeyed on that elevator, we said this was your first time. Well, 2 weeks from now, it happens to you, you say, I'm going to take it. It was enjoyable just doing nothing and taking my coffee. Got on that elevator again and rode it up and down, and you observed different things at different levels. So remember, before you only stopped at the conference room floor, you stopped at the roof deck, and you stopped at the lawyer's floor. Now you stop at some other floors. So you've now made other observations about different levels. Now we call these support and resistance because not hypothetically, in the old days, as price moved up, it would be the resistance level where price would hit that previous price and bounce off of it. it would stop price moving. Or if price was above it, it would support that price. So when price started coming back down, it would support that price and move back up. But the thing is, support and resistance levels are interchangeable because as price moves down, it's a support level. Price moving up, it's a same price level. So we could just stop and think of them as floors or alert zones. So a buy zone could be a buy zone as price is moving up. It could be a sell zone as price is moving down. Or again, imagine a ladder. Well, you climb up the 20 stairs of the ladder. You're painting the side of a house, and you're up the ladder steps, down the ladder steps, up the ladder steps, underneath the bedroom, but the same ladder steps. So sometimes you're stepping down on that ladder step, and sometimes you're climbing up. Same thing with the elevator. Sometimes you're going up and down. Those floors are still the same. The importance of those floors is more significant because the conference room would be more significant in, say, the afternoon when there's conferences, but in the early morning, that roof deck, and then especially at lunchtime, or if it's 8 o'clock in the morning now, at 9 and 10 o'clock, people will be taking breaks and going up to that roof deck. So they become more important. Where the conference room, because there's no conferences in the morning, and basically when the elevator stopped on the conference floor, you could see the sign that had the conference, and there was nothing even scheduled until 1 o'clock that day. So how important that floor is, when we should expect actions and reactions. So your support and resistance levels should always be on your charts because they help you see the whispers in the marketplace. They help you look at price and instantly tell a story. Now, the reason you see so many of these lines on my charts is because these lines were price levels in the past that were significant in that journey of the elevator. And we've drawn them on the charts. Okay. Each time, because you don't go back and repeat these lines over and over. You don't go back and say, today this. No, these are lines that historically, or in the past, or the last time this asset was making a journey, told us a story or significantly important. Okay, now we can see my orange dashed line here is very, very old. But look how important that level was right here to price. Okay. My blue line here was a minor support level in the past, not so long ago, but look how important that was in this journey. You can see how now none of these have been drawn on this chart in the last month. These are when I was on this elevator the last time, 3 times ago. And they help us decipher what the markets are going to do now. And look at this, my blue support zone, or my blue, what happened right here? Price moved up, hit this red zone, which we could call a resistance level, hugged it, and then fell off, and it's coming all the way back down here to the blue, which is considered a support zone because it'll support the price. But if we just say this is a step on the ladder or a floor on the elevator, we're starting to understand what the markets are trying to tell us. And we need to be able to uncode these whispers. So the only thing that I place on my charts is my support and resistance. I use these support and resistance areas in conjunction with candlestick analysis to make trades and understand what the market is trying to tell me. Okay. Because you can't make any decision just with a support and resistance zone. Okay. But once we have something on our charts, we can start understanding what's supposed to be going on. So if we go back and then we say, let's take a look at what the candles tell us whenever we hit these prices. Okay. All I did was magnify the chart so you can see the candles a little better. I didn't change anything. But if I get a bullish engulfing or a bearish engulfing pattern, or I get a doji right on that support or resistance, it's trying to tell me something more. Okay, look at what happens. I've gotten 3 tiny bottle-bodied candles right here, okay, that have told me that the bulls have completely exhausted the markets and have left the markets, and the bears are taking over. Okay. So I can then start interpreting depending on how I trade. It's what you have to decide is important to you. And the only way you can decide which is important to you is by practice and hold on one second. By practice and evaluation and constantly by defining your strategies. And so you're constantly trying to understand what the market is trying to tell you. So why? Well, this happens all the time at every forex pair, at every financial market, for that matter. It's not something I made up. Support and resistance is strategically important in every market because this is how the market works. Buys and sell orders are grouped together in the same general area, and when they are hit, we see the impact on price. So remember, whether price is moving up or down, it moves in peaks and valleys. Okay. Now, this is a very well-defined price movement. Price movement can be like this. But when we see a nice defined price movement and its peaks and ease and push and push and ease, push and ease, what we'd be expecting to see is each one of these pushes to push up towards a resistance line and be stopped at resistance. It'll ease back down to a support level and then push back up to the next resistance level, push down, and this is what forms these peaks and valleys in the markets. Okay. Well, you could say this is a bunch of hogwash, but if you understand how the markets work, okay, markets are sitting here, you don't know nothing about what's happening at the moment, but some of the big buyers, not us, not retail traders, the investment houses, the central banks, the big guys with millions and millions of dollars who aren't using leverage, they're not trade, they're looking to make profit. This guy has to bring in $100,000 every day and on his trading portfolio because that's his job. Well, they buy at this level. They're not coming in the markets to gamble that the markets go like that. They just want to see the market rally to this point. So he sets his buy order, he sets his exit order, and he takes it to there. Okay. As the market starts moving up and other of these big buyers start going in, they all know what level they're going to push. This guy wants to make 20 pips per trade or 20 pips per investment. This guy wants to make 50. They all set their sell orders or their exit orders at about the same level. And where do they get this level? They get it from the previous resistance level. Where the last time is that the price pushed up and what stopped it from moving up. Not what made it dead stop, not what ended the trend. What point in that asset's journey did it step down to the next ladder or had a difficulty stepping up to the next level? Okay. Now what happens is because they've all set up their sell orders here, this journey, this asset starts easing back down, only because these sell orders have been generated. Now what happened is some of these other buyers, as price moved up towards that sell order area, they don't know exactly what that sell price is or who's done what. Okay. They're saying to themselves that price has gotten too high. It's no longer a good investment. As the price falls off of that resistance level, as those sell orders get executed and the buyers are moving to the sideline, that price eases down. At some point, it's cleared out all those sell orders, and these buyers are saying, that price is now low enough. It looks good. I'm going to enter the market. And they start generating that market movement. And then we all start jumping in and we push it farther and farther. But this is how the market moves. Okay. So even though we say it's a bunch of hogwash, it really isn't. Because this is how the market works. So what we want to do is understand how to place an order and actually how to build our strategy. There's lots of indicators out there that all claim to give you great support and resistance areas. I've tried them all and I do not find them reliable. support and resistance placements still need to be done by a person, by you. And that's what makes you better than the next guy. It makes you the Euro whisperer because your lines are different than the guys next to you lines because you've done some better research, more defining. And it gives you the better trading decision. Now, there are 3 key rules to keeping in mind when placing support and resistance areas. Place the areas based on the body of a candle. Just don't look for areas where the wicks have gone all the way up here. Look historically by going back on your charts and looking at, as price was moving up or down, where price got stuck. Not that it didn't continue to climb up. Price was moving up in that elevator. What floor did it stop at for a second before it went up to the next floor? When it came back down, what floor did it stop at before it hit the ground level? What floors were important? Now, the more recent the bounces, the more important. Prioritize recent bounces over older bounces. You need at least 2 connecting bounces to place a support or resistance area. Okay. So it's important to go back and look at your chart. So first you start looking, you just move your charts to back to daily charts or to weekly charts and look at that and start placing them. And then keep zooming in and draw them. Once you have them on your charts, you never have to add them anymore, but you have to start somewhere. Like when you look at my chart, I never have to add those on. Now, maybe in the future, a new line will develop and maybe an old line won't be holding out so good. And that's why I changed the colors because they do mean something to me. Okay. So you're updating them now and then based on only current movement. But when the euro goes back up to 129 again, all my levels from the past, 2 years ago when the euro was trading at 129, all come back to become relevant again, and they're all on my charts. It's just as the price moves up and down, all those levels start to become the floors around price. Now, if you combine that with candlesticks, not candlestick analysis, most new traders learn a little bit about candlestick analysis, but most of what they learned is totally useless. Why? The standard approach to candlestick analysis is basic pattern recognition, which fails to work in real trading. But you can't skip straight forward from candlestick analysis to advanced analysis. You need to understand the basic formats. But I tell you, don't memorize them. Don't spend hours reading about what they should be. There's certain ones that are very important. But these are called memorizing. These are called pattern recognition. It doesn't do you much good. In fact, today, most charts will drop them on there for you. You can just tell them to put the candlestick patterns on you. But for a price action trader, this is useless. And it's worse than useless because you get tied up trying to think of what you're seeing, what it's supposed to be telling you, and everything else. So it gives you tunnel vision. So all candlesticks need to be assessed based on the candles around them and many other factors. But you should know some of the candles that can be important in your journey. Okay. But they can all mean a lot of different things. But it's where they appear in the story of price. So every single candle on your chart is telling you a story. And when you combine those candles together, you get the story of price, not a memorization of what these patterns were, but an understanding of price and who was in control. So if you start to look at some of the basic candles, you know when it's got a very small body and a small wicks, the markets are very undecided. Having lots of blue, lots of greens and lots of reds don't really mean much of anything. But when you get a very specific candle and then the next candle is like the opposite, but we're fully engulfed in it, that can tell you something, especially when it's appearing directly on your support or resistance level. So indecision candles occur when neither buyers or sellers can gain or maintain control of price. And they are common, but if used in the right way, they can be very powerful. When an indecision candle forms directly on a level of support or resistance, it's trying to tell you something. The markets have reached indecision. Now, there's no guarantee the market's going to turn against you and go down or continue up and go upward. It's telling you that the current movement, that the buyers is facing a lot of indecision. So when it appears directly on a support or resistance level, and you get that indecision candle, you don't know which way the market is going to go. But when you know something's going to happen at this level, you can now start doing your analysis for either direction. So when price hits resistance, we get an indecision candle forming right on it. So what happens when you have that, you now know only three things can happen. Price can break above that resistance level or that alert zone and move upward. Price can fall downward and go downward, or price can stay the same. Well, now you have three potential trades you can set up. And when you have three trades instead of two, you have a much better advantage of making the right decision. So if you were to see this indecision candle on the resistance level and say you thought it was going to continue up and you told it only to buy that asset when it broke above that resistance level, you would buy up here, and you told it if it moved against you and fell back down to below that resistance to sell down here, and you took your profit up there. If the market didn't drive that candle or didn't drive price continually upward, your trade would have never gotten executed. So the only way you get hurt is if the market pushed up, moved up, and fell right back down. So price action allows you to take many different types of trades: reversals, continuations, range, swing, breakout, scalp trades, just to name a few. So you always want to look at the preceding trend, the reversal trend, the indecision candle, but you always want to watch the trend, support and resistance, and understand what price is trying to tell you. You want to hear the whispers of the marketplace. So why does it need to happen on support and resistance levels? Well, indecision candle in a bullish preceding trend indicates that buyers are possibly losing control, or the opposite. However, an indecision candle does not indicate that price will reverse with any degree of certainty. An indecision candle only indicates one thing: indecision. Now, when you have that indecision on a support and resistance level, you can then set up your trade. And it's always about getting in at the right time, making the right decision. And that's all about being able to understand what the market's trying to tell you, by understanding and feeling the whispers from the market. Because failed trades happen. There's nothing you do about them. But getting in at the right time lowers your percentage of failed trades. Many people wait for a candle to close to get in, but I have thoroughly tested, and waiting for the candle closes gets you in too late. So you want to be ready to enter your trade when things happen. So in this case, using our support and resistance level, we see our indecision candle forming right here. We would put our stop loss at the right above its highest wick. We put our entry point right below its lowest wick, and we would have sold into the bounce of the markets. If the markets didn't do what you said and move this way, your trade would have never gotten executed. If the markets moved up, you would have never had a trade. If the markets fell down, your trade would have been executed this level, and hopefully it would have continued down to the next resistance. But if it fell down here, your trade got executed and turned and reversed itself, you would have still only suffered a very tiny loss. And remember, losses are part of trading. Come on, computer. So there are many different ways to start. I always start out with my trend line, then my support and resistance. Then I look at price action. And finally, I look, and the ultimate key to everything is volume. Volume, you can think of as the volume of the whisper. The louder that whisper, the bigger the volume, the more your trade is being confirmed. You only want to trade if volume is increasing where you want to execute it, because you're not the only trader in the world doing this thing. But this could be your entire strategy. In trading, a lot of people tend to overcomplicate simple concepts. Sure, some of the concepts of trading are not the sort of thing you would know intuitively, but many things are easy. You just must know what to look for, what to listen for. So thank you very much for joining us tonight. Have a great trading week, and thanks for being part of the Alvexo family. Good night now.